I actually want to start with one of Lyn's charts here. If I can pull this up. And ultimately, I'm really interested in this idea of comparing different periods in history. Is this idea of comparing the 1940s and the 1970s as different time periods? So I guess, why did you think to put together these two charts that we're looking at here, which is kind of a history of, for those of you not watching on video, century of U.S. debt as a percentage of GDP and a century of U.S. monetary and fiscal policy? What does that tell you about those two specific historical analogs?
So I've generally found that the idea of the long-term debt cycle is, the kind of the closest thing I have to like a master framework for what's going on right now. And it's one of those things where obviously every cycle is going to be different. It goes back to that quote that is, I don't know if it's correctly or incorrectly attributed to Mark Twain, but it's like, history doesn't repeat, but it does rhyme, right?
Mm.
So when, we went into this period and people keep talking about these, extraordinary events happening, unprecedented, never seen these types of things before. And just by happenstance, I had been researching this topic for years and just kind of, it's one of those things you never know exactly why you come across the right sources. But I came across this type of research. And so this actually, in my view, prepared me for what we went through over the past 2 years. Because we did have an historical analog for it. We did have some bottlenecks. And so basically what this shows is that, we go through the normal business cycle, and most people just think in terms of those 5 to 10 year increments. But what we see through history is that, for reasons related to demographics and politics and, distributions of power between capital and labor and all sorts of reasons, we go through these long-term debt cycles as well. And so basically this chart shows, 100 years of history in terms of fiscal policy and monetary policy in the United States. And so we can break it apart into, the chart on the left there shows private debt as a percentage of GDP. There's technically a little bit of state debt in there too, but essentially it's all the debt sources of entities that cannot print their own money. And then you have federal debt in blue. And we see the history of kind of debt accumulation over time. And then on the the right-hand chart, you have short-term interest rates. You have monetary base as a percentage of GDP, and you have fiscal deficits in gray lines as a percentage of GDP. And, it doesn't tell you everything, and there are differences between the 1940s and the 2020s, obviously, right? So there's technology differences, there's demographic differences. Back then we were a creditor nation, now we're a debtor nation, structural trade deficit nation. But there's a lot of similarities. And so basically what they did last time was they had so much debt in the system, they had so much fiscal spending, and so when they did that massive fiscal spending and it was inflationary, they were still pretty much forced to hold interest rates low anyway. And so that was kind of different from the 70s. And basically, it's just the way that I'm kind of thinking about this environment and then using that as a framework so that, this is kind of my baseline. And then I look to see what is different. So what are the differences from that period? What is happening in this time? What are the specifics? And go from there. But I really find that this helps contextualize where we're at.
Yeah, I would agree. I do notice that you've called out a couple of banking crises here. Is that just a coincidence, or is that a strain on how would you put the causal arrow there? Is it, you think some of these strains stress the banking system, or are they causal and actually creating some of the problems?
Well, as we see, those were peaks in the private debt to GDP cycle. And so you generally had speculation and all sorts of things leading up to those, different specifics. But you essentially had, speculation and debt accumulation and basically malinvestment leading up to those. But because, a debt bubble popped, and because it was so big, instead of a normal credit cycle, you had unusual measures taken, right? So you had currency devaluations and other things like that to, address those. And so on one hand, you had some nominal defaults, but you also, kind of changed the denominator, currency itself, right? So in the 30s, you eventually devalued the dollar relative to gold. And in the 2000s and 2010s, we did quantitative easing. We recapitalized banks. We did the trouble asset relief program. So both of those were ways to try to salvage the banking system and start, reducing that debt, partially through defaults, but also just partially through, diluting the currency.
Yeah, and if I just add to the excellent points that you just made, Lyn, the financial crisis was obviously a bursting of a private debt bubble, right? Banks, corporates, households, There was not really a government debt issue at the time. But then the debt, through QE and the TARP and everything got essentially redistributed to the government. And it didn't happen exactly like that in the 30s and 40s, but in the early 30s, you had the private debt bubble, and then in the 40s, you had this massive run up in government debt, during World War II, and there are definitely parallels there. And now we're in this financial repression age, just like we were in the 1940s, where governments can't afford high interest rates because there's too much debt out there.
If I'm looking at these two periods of time, the primary factor that sticks out for me is you had periods of secular inflation, both in the 1940s and the 1970s, for different reasons. The primary difference there was interest rates and how the government or the central bank controlled them to try to mitigate the crisis. So back in the 1940s, it was unpalatable to raise interest rates. You essentially had yield curve control, and there was an era of financial repression. And in the 1970s, debt levels were relatively low, and you obviously had Volcker, who aggressively combated that inflation by famously hiking interest rates and successfully, I guess, fighting that inflation. Is that an accurate summary, or am I missing some of the nuance there?
So I would say that basically there were different bottlenecks. So the 2020s and 1940s were a federal debt problem, as Urian mentioned. And so those were the inflations of those eras were in large part from the fiscal stimulus that was necessary for external reasons. Basically, those external reasons kind of forced these big almost like MMT like programs. The 1970s had a different set of constraints because, as the chart shows, at that point we had already inflated a lot of the debt away. We had pretty low debt. We also had a strong era of growth for a while, and so both public and private debt were low, and so they were able to raise rates. In that era, the bottlenecks were a couple. One is obviously we went off the gold standard, and I've had other articles where I've shown chart, for example, that if you looked at foreign ownership of treasuries, because those are the ones foreign ownership of dollars and treasuries, which by extension are dollars, were the ones that were still redeemable for gold. And so we started to have this period throughout the 50s and 60s where our gold reserves were drawing down, but our external liabilities were increasing, and eventually we had a crossover point. And the French and other creditors started to notice this, so they started wanting the gold. And so basically we essentially had too many dollars to keep backing them by gold at that rate, and so we had a breakdown of our monetary system. And then two, if you look at domestic U.S. oil production, it peaked in 1970, and it then went structurally down for decades. We basically just ran out of the ability to keep expanding conventional oil at that pace. So we're obviously still producing it, but we were producing it less, even though our demand was still growing. And so we had to shift towards more imports. And that, of course, when you're also going off the gold standard, we had a variety, basically an inflationary environment for those monetary reasons combined with those physical restraints connected to energy and other things. And so I would describe the 70s as a lot more specific compared to the closer analogy with the 2020s and the 1940s. But there are elements from the 70s as well. I mean, we have similar fiscal programs, and I think we're arguably going to have some energy shortages.